Look, I know you think about bonds, but not too much. And that is exactly why today matters. Bonds are the most rational part of the markets, the place where emotion goes to die. And yet they've been stuck in a 4 to 4.5% range for almost 3 years, despite falling inflation and Fed easing. And you might be asking yourself, why are these long term yields staying so high? So let's start with the obvious, the deficit. When the government spends more than it takes in, it borrows. That borrowing takes the form of treasury bills, notes, and bonds. More supply means lower prices and higher yields. Well, that's pretty simple. But a new wrinkle is emerging, and it comes from the most unlikely place: AI. Yeah, the same technology driving trillion-dollar market caps is now knee-deep in the bond market's business. According to a new report from BlackRock, the next big wave of bond issuance may come from the cleanest, strongest, most profitable balance sheets on the planet. Think Nvidia, Amazon, Meta, Microsoft, Google. You know these companies. These are the ones that they don't need to borrow to survive, but they need to borrow because AI requires an enormous amount of upfront spending. Data centers, power infrastructure, chips, cooling, real estate, fiber, and debt just is the cheapest way to fund long duration projects. So even if they could pay cash, they won't. They'll just tap the bond market because it's just more efficient. And here's the twist. The bond market, it doesn't care whether the issue is a struggling steel mill or a $1 trillion AI colossus. It only cares about supply. More supply pushes yields up, period. So now you have two sources of massive bond issuance hitting at the same time. You have the government floating trillions to fund the deficit, and mega cap tech floating billions to build out the AI supercycle. The Fed controls short-term rates, but the long end of the yield curve, well, 10 years and 30 years, that belongs to supply and demand. And right now, the supply side is about to get even heavier. And this is where stock investors need to pay attention. Higher long-term yields don't just hit mortgages, they hit valuations. The higher the discount rate, the lower the present value of future cash flows. And whose cash flows are the most future heavy? Well, growth stocks, tech stocks, AI stocks. So while everyone is celebrating the AI boom, the bond market is quietly saying, hey, this party has a cost. So your truth bomb for today is this: the next big AI story of the next decade may not be in the stocks, but in the bond market that they secretly distort.